I'm watching something break in real time, and I need you to see it before the morning headlines bury it under the usual noise. My name doesn't matter, but my access does. I've spent 12 years as a private commodities analyst, and I built this channel for one reason. I was tired of waiting half a day for Bloomberg to report what I had already seen on my terminal at 2 in the morning. And frankly, I was tired of watching all these AI avatar channels pump out garbage silver content with fake urgency and zero data. So here we are. You're getting the real feed, unfiltered. Because if you're stacking physical or trading futures, you deserve to know what actually happened last night while you were asleep. Here's what I'm looking at right now. Silver spot price, $87.59, down 5%, down $4.61 from where it closed yesterday. That's not the story. The story is how it got there. Around 10:40 last night, Eastern Time, someone dumped approximately 2,000 futures contracts into the COMEX order book during what traders call the empty hours. Low liquidity, skeleton crew, the overnight bridge between New York close and London open. It's the window where a relatively small amount of selling pressure can create a disproportionately violent price move because there's nobody on the other side of the trade. And that's exactly what happened. Silver got hammered from a $92 high down to $87.59 in what can only be described as a vertical line on the chart. Now, if you're new to this, you might be thinking, okay, so someone sold, markets go down. What's the big deal? Here's the big deal. While paper silver in New York was getting slaughtered, physical silver on the Shanghai Futures Exchange was trading at $100.59 per ounce, not 87, 100. That's a $13 premium, the widest gap between Eastern and Western silver pricing in modern recorded history. So let me ask you the obvious question. If silver is really worth $87, why is someone in China paying $13 more for the exact same metal? And if silver is really worth $100, why did New York just crash it by 5% in the middle of the night when no one was watching? The screen is lying to you, and the reason why involves a desperate move by some of the world's biggest banks to keep a lid on something that's already broken loose in the East. Here's what I'm going to do in this video. First, I'm going to show you the exact data from last night's price action, the volume, the timing, the levels. Then I'm going to teach you about a market condition called backwardation, which is flashing red right now in silver, and is the single most important warning signal you can get in a commodity market. After that, I'm going to run the math on this $13 Shanghai arbitrage and explain why it's not closing, which tells you everything you need to know about the physical shortage. Then I'm going to address the skeptics, because there's always someone who says, this is just a healthy correction, and I want to steelman that argument before I dismantle it. And finally, I'm going to tell you exactly what I'm watching and what my personal plan is going into Friday's close, because by Friday afternoon, we're going to know whether the paper wall holds or whether this thing finally cracks wide open. Let me give you the hard numbers first, because everything else builds from here. I was looking at the data a few hours ago, January 14th, around 10:40 in the evening Eastern Time. Silver spot price, $87.59. That's a drop of $4.61, or 5%, from where we were trading earlier in the session. For context, gold was down less than 0.5%, 45.93, barely moved. The dollar index, we don't have the exact print, but based on the relative weakness in metals, we can assume it was relatively stable or slightly firmer. So this wasn't a risk-off event. This wasn't some macro shock hitting all commodities. This was surgical, this was targeted, and it happened in the lowest liquidity window of the entire trading day. Now let me explain what I mean by empty book. The COMEX futures market trades nearly 24 hours, but volume is not evenly distributed across that time window. The heaviest volume happens during New York trading hours, roughly 8:30 in the morning to 1:15 in the afternoon Eastern. After that, you get some spillover and then things quiet down significantly. By 10 o'clock at night, you're in what's called the overnight session, and liquidity is thin. There are fewer market makers, fewer institutional traders, fewer counterparties willing to step in and absorb large orders. It's like trying to sell a house at 3 in the morning. You might find a buyer, but you're not going to get a fair price because there's no competition. So when I see 2,000 contracts hit the tape at 10:40 at night, I know exactly what's happening. Someone is not trying to get the best price. They're trying to move the price. 2,000 contracts is 200,000 ounces per contract. So we're talking about 10 million ounces of paper silver being sold in a single coordinated wave. And because the book is thin, that selling pressure doesn't get absorbed. It cascades. It triggers stop losses. It forces liquidations. And the price waterfalls straight down. That's not a market finding equilibrium. That's a market being pushed off a cliff. Now here's where it gets interesting. While New York is printing $87, I'm watching the Shanghai Futures Exchange, and physical silver over there is trading at $100.59, $13 higher. Not a typo, $13. I've been doing this for over a decade, and I have never seen a premium that wide between East and West, not even close. The normal spread is maybe 50 cents, maybe $1 on a volatile day. $13 is not a spread. It's a chasm. It's a market dislocation. And it tells you that the price discovery mechanism has completely broken down. Let me explain what this means. In a functioning market, arbitrage should close that gap almost instantly. If silver is 87 in New York and 100 in Shanghai, traders should be buying in New York, shipping the metal to Shanghai, and selling it there for a $13 profit per ounce. That arbitrage pressure should bring the prices back into alignment within hours, maybe a day at most. But the gap isn't closing. It's been sitting there. And the reason it is not closing is because there's no physical metal available in the West to buy and ship. The vaults are either empty, or they're not willing to release inventory, or there are delivery delays being blamed on logistical issues. Whatever the excuse, the result is the same. The paper price in New York is meaningless if you can't actually get the metal at that price. And that brings me to the third critical data point, backwardation. The silver futures curve has inverted. Spot silver, meaning immediate delivery, is trading 30 cents higher than the March 2026 futures contract. That might sound like a small number, but in commodity markets, it's an earthquake. Let me explain why. In a normal, healthy commodity market, the futures curve is in what's called contango. That means prices for future delivery are higher than the spot price. And that makes sense, right? If you're going to store silver for 3 months, you have to pay for the warehouse, you have to pay for insurance, you have to tie up capital. So the March contract should trade a little higher than the spot price to compensate for those carrying costs. That's contango. It's the natural state of things. When the curve inverts, when spot is higher than futures, that's called backwardation. And it means the market is screaming for immediate delivery. It means buyers are so desperate for physical metal right now that they're willing to pay a premium to skip the line. They don't want a contract for March. They want the metal today, and they're willing to pay more for it. And let me give you an analogy that makes this click. Imagine there's a concert, a huge artist, sold-out show tonight. You go online to buy a ticket, and you see 2 prices. A ticket for tonight's show costs $500. A ticket for the same artist, same venue, 1 year from now, costs $300. Why would tonight's ticket cost more? Because people are terrified the band might not be around next year, or they might not get another chance to see them. Or maybe they just desperately want to be there tonight, and they're willing to pay a premium for immediacy. That premium is backwardation. It's the market pricing in scarcity, urgency, and fear that the future delivery might not happen. So when I see silver in backwardation, when I see spot prices trading higher than futures, what I'm seeing is a market that doesn't trust the system anymore. I'm seeing buyers who are saying, I don't want a paper promise for March. I want the metal in my vault today, and I'll pay extra to get it. And the fact that this condition is persisting, the fact that it's not snapping back into contango, tells me that the shortage is not theoretical. It's not some conspiracy theory. It's mathematically encoded into the price structure of the market. Now, let's talk about what this looks like from the perspective of the big players, the bullion banks, the market makers, the institutions that are short silver futures and need to either deliver metal or roll their positions forward. If you're short a March contract and the market is in backwardation, you have a problem. Because normally you could just roll that short position into the next month, into April or May, and you'd actually collect a small credit because of the contango. But now, rolling forward costs you money because the curve is inverted. And if you try to deliver physical metal to satisfy the contract, well, good luck finding it at $87 when the Chinese are paying $100. So what do? You smash the paper price, you dump contracts into the overnight session when liquidity is low, and you drive the spot price down below $88, ideally below $85, to try to shake out the weak hands, to try to trigger stop losses, to try to scare retail buyers away from taking delivery. And that's exactly what I think we saw last night. This wasn't profit-taking. This wasn't technical selling. This was a coordinated effort to defend a price level. And I'm going to tell you why I think that price level is so important in just a minute, because it has everything to do with options expiration this Friday. But first, I need you to understand how backwardation functions as a trap for the shorts. When the curve inverts, it's not just an inconvenience. It's a signal that the paper market and the physical market have decoupled. Paper silver is trading at 87. Physical silver, the kind you can actually hold, is trading at 100 or more in Shanghai. The paper contracts are supposed to represent claims on physical metal, but if those claims can't be satisfied at the paper price, then what are you really holding? You're holding a promise that's worth less than the metal it's supposed to represent. And as more people figure that out, as more buyers demand physical delivery, the pressure on the shorts becomes unbearable. They either have to pony up the metal, which they don't have, or they have to buy back their short positions at whatever price the market demands, which could be catastrophically higher than where they sold. This is what traders call a squeeze, and the backwardation is the first symptom. It's the market telling you that the physical metal is being hoarded, that the available supply is drying up, and that the people who are short are running out of ways to satisfy their obligations. So when I see a 30-cent backwardation in silver, I'm not thinking, oh, that's interesting. I'm thinking, the trap is set. The question is how long it takes to spring. Now let me show you the math on the Shanghai arbitrage, because this is where the absurdity of the situation becomes undeniable. Let's say you're a big player. You have access to the COMEX. You have access to physical metal. You see silver trading at $87.59 in New York and $159 in Shanghai. That's a $13 spread. You buy 1,000-ounce bars in New York at $87. You ship them to Shanghai. You sell them at $100. Your profit per bar is $13,000. Now, there are costs involved. Shipping, insurance, maybe some fees. Let's say all in, those costs are $2 per ounce, or $2,000 per bar. Your net profit is $11,000 per bar. That's a 1,000-ounce bar, by the way. If you're moving 100 bars, you're making over $1 million in pure arbitrage profit. No market risk, no directional bet. Just buy here, sell there, collect the spread. So why isn't everyone doing this? Why isn't the gap closing? Because you can't get the metal. The vaults in New York and London and the major LBMA storage facilities, they're either refusing to release inventory, or they're claiming delivery delays due to logistical challenges, or they're requiring you to wait weeks or months for your allocation. And by the time you get it, who knows where the price will be. Meanwhile, the Shanghai premium stays elevated because Chinese buyers are willing to pay whatever it takes to secure physical metal right now. They don't care about the paper price, they care about possession. And as long as they're willing to pay $100 while the West is printing $87, that $13 spread is going to act like a vacuum cleaner, pulling every available ounce of silver out of Western vaults and into the East. And this is why last night's dump is so significant. The banks are trying to lower the paper price to make that arbitrage less attractive. They're trying to widen the gap to a point where the logistical friction and the time delay make it not worth the effort. But all they're really doing is making it cheaper for China to keep buying. They're feeding the beast. They're accelerating their own demise. Because every ounce that leaves the West at $87 to be sold in the East at $100 is an ounce that's gone. It's not coming back. And the vaults get a little lighter, and the squeeze gets a little tighter. Let me give you a quick recap of where we are so far, because I know I'm throwing a lot at you. Silver crashed 5% last night, $4.61, but it crashed on low volume during illiquid hours. Meanwhile, physical silver in Shanghai is trading $13 higher than the paper price in New York. That gap should be closing through arbitrage, but it's not, which tells us there's no available physical supply in the West. And on top of all of that, the silver futures curve is in backwardation, meaning spot prices are higher than futures, which is the ultimate red flag that the market is desperate for immediate delivery. Those are the verified facts. Those are the things we can measure and point to on a chart. Now let me talk about the unverified rumors, because there are some theories floating around that I can't confirm but that you should be aware of. Rumor number one, the banks are shorting to keep the SLV ETF below $80 by Friday, is close. Here's the theory. There's a massive amount of call options on SLV, the big silver ETF, that expire this Friday. A lot of those calls have an $80 strike price. If SLV closes above 80, those calls go in the money, and the market makers who sold those calls have to hedge by buying millions of ounces of silver. That buying pressure could trigger what's called a gamma squeeze, where the hedging demand pushes the price even higher, which forces even more hedging, which creates a feedback loop. So the theory goes that the banks dumped futures last night to drive the price down and keep SLV below 80, thereby killing the gamma squeeze before it starts. I can't verify that. I can tell you the timing is suspicious. I can tell you the $80 level is real, and there are a lot of open interest calls sitting right there. But I can't prove intent. So take that for what it's worth. Rumor number two. Force majeure clauses are being invoked, or are about to be invoked, at major Western vaults. A force majeure is a legal clause that allows a party to a contract to delay or suspend their obligations due to extraordinary circumstances beyond their control. War, natural disaster, that kind of thing. The rumor is that some of the big vaults are considering invoking force majeure to delay physical deliveries because they don't have the metal on hand to satisfy the claims. Again, unverified. But if that headline hits, if we see a major institution announce delivery delays due to force majeure, you'll know the shortage is no longer a rumor. It's official. Rumor number three, major Mexican silver miners are withholding supply until prices hit $100. Mexico is one of the largest silver producers in the world. The theory is that some of the miners have seen the Shanghai prices, they've seen the backwardation, and they've decided to sit on their production and wait for Western prices to catch up. I have no confirmation of this, But if it's true, it would explain why the physical shortage is getting worse, even though production is still happening. The metal's being produced, it's just not being sold into the market. I'm telling you these rumors, not because I believe them all, but because they're circulating, and part of my job is to give you the full picture. Verified facts over here, unverified theories over there. You decide what makes sense based on the data. Now, let me talk about the skeptics, because there's always a counter-argument, and I want to address it head on. The skeptical view goes like this. Silver ran from $80 to $92 in 48 hours. That's a $10 move. A 5% pullback is not only normal, it's healthy. This is just profit-taking after a vertical rally. You're seeing conspiracy where there's only market mechanics. And I'll be honest with you, that's a reasonable argument on the surface. Markets do correct. Bull markets do have pullbacks. So let me explain why I think this particular pullback is different. First, the timing. If this were normal profit-taking, it would have happened during regular trading hours when there's liquidity and price discovery. Instead, it happened at 10:40 at night when volume is at its lowest and the order book is at its thinnest. That's not how institutional profit-takers operate. They don't dump 2,000 contracts into an empty book and take a worse price than they could have gotten during the day. They scale out. They use algorithms to minimize market impact. They spread their selling over hours or days. What we saw last night was not profit-taking. It was price suppression. It was someone who wanted the price lower and didn't care about getting the best execution. Second, the lack of fundamental news. If silver were correcting because of some new information, some change in the macro landscape, we'd see it reflected in other assets. Gold would be down hard, copper would be weak, the dollar would be ripping higher. But gold is basically flat. It's down less than 0.5%. Copper didn't crater, the dollar didn't explode. So what changed in the silver market specifically to justify a 5% dump in the middle of the night? The answer is nothing. Nothing fundamentally changed. Someone just decided to sell a lot of contracts very fast. That's not a correction. That's an intervention. Third, the backwardation. If this were a normal correction, if speculative fever were breaking and the bubble were popping, the futures curve would be flattening or moving into steeper contango, you'd see the fear premium come out of spot prices. But instead, we have backwardation. Spot is trading higher than futures. That's not what happens when a bubble pops. That's what happens when the physical market is so tight that buyers are bidding up the near-term contracts and ignoring the back months. It's the exact opposite of what you'd expect in a correction. And fourth, the Shanghai premium. If the Western correction were real, if silver were really finding a lower equilibrium price, arbitrage would close the Shanghai gap. Traders would sell Shanghai, buy New York, and pocket the spread. But the spread isn't closing. It's staying wide. Because the New York price is fake. It's a paper price that doesn't reflect the physical reality. And the Shanghai price is real. It's what people are actually paying to get their hands on metal. So when I see a $13 gap persisting for hours, for days, I don't see a correction. I see two markets that have decoupled entirely. Let me show you one more thing that makes the skeptical argument fall apart. Look at the volume profile from last night. 2,000 contracts were sold in a very short window. But in the hours before that, volume was light. And in the hours after, volume stayed light. If this were a broad-based de-risking event, if retail traders and institutions were all heading for the exits at once, you'd see sustained heavy volume over a longer period. Instead, we saw a single spike, one dump. And then it went quiet again. That's not market behavior. That's someone executing a specific trade with a specific objective. And the objective was to move the price lower, fast, before the East opened and had a chance to react. So no, I don't buy the healthy correction narrative. The timing is wrong. The volume is wrong. The fundamentals don't support it. And the price action in Shanghai directly contradicts it. This was a targeted move. And the question now is whether it works. Let me tell you what I'm watching going into Friday's close, because Friday is the line in the sand. Here's why. Options expiration. Every month, futures options expire, and this month, there's an enormous amount of open interest in call options on both the silver futures and the SLV ETF. A lot of those calls are clustered around the $80 strike. If SLV closes above $80 on Friday, those calls go in the money. The market makers who sold those calls are short gamma, which means they have to hedge by buying the underlying asset, which in this case is silver. And when they buy silver to hedge, that pushes the price higher, which makes even more calls go in the money, which requires even more hedging. It's a feedback loop. It's what caused the GameStop squeeze. It's what caused the volatility squeeze in 2021. And it could happen in silver if the price closes above that $80 level. So the banks, or whoever's short these options, have every incentive to keep the price below $80 by Friday's close. That's why I think we saw the dump last night. It wasn't about fundamentals. It wasn't about corrections. It was about pinning the price below a critical level to avoid a catastrophic gamma squeeze. And now the question is, do they have enough firepower to keep it there for another day and a half? Here's what I'm watching. First, the $80 level on SLV. If we bounce and break back above 80, if we close above 80 on Friday, I expect extreme volatility on Monday. The hedging flows could be enormous, and that could be the spark that finally breaks the dam. Second, I'm watching the Shanghai Premium. If it widens from $13 to $15, that's a sign that the Eastern buyers are getting even more aggressive and the Western vaults are even more drained. At $15, the arbitrage becomes so compelling that it overrides almost any logistical friction. And third, I'm watching the backwardation spread. Right now it's at 30 cents. If it widens to 50 cents, if spot starts trading meaningfully higher than the front month futures, that's a sign that the squeeze is accelerating and the market is losing confidence in the paper contract, his ability to deliver physical metal. Now, let me tell you my personal plan, because I know some of you are sitting on physical, some of you are trading futures, and you want to know what I'm doing with my own money. I'm not giving you advice. I'm telling you what I'm watching and what my triggers are. First trigger. If silver dips to $83, I'm looking to add to my physical holdings. 83 is a key support level. It's where we bounced a few days ago on the way up. If we test it again and hold, that's a sign that the bull market is intact, and this was just noise. I'll be buying physical bars at that level. Not paper, not futures, physical. Because if the shortage is real, and I believe it is, the paper price is going to become increasingly irrelevant. What matters is whether you have the metal in your possession. Second trigger. If SLV closes above $80 on Friday, I'm sitting on my hands over the weekend and waiting to see what happens Monday morning. If the gamma squeeze kicks in, we could see a massive gap up. I'm not chasing that. I'm not buying into a squeeze. I'm waiting to see if the momentum sustains or if it's a one-day spike that fades. Third trigger. If the backwardation hits 50 cents, I'm ignoring the screen price entirely. At that point, the paper market is a fantasy. The real price is whatever physical metal is trading at, and that's going to be significantly higher than whatever COMEX is printing. I'll be focused on vault data, on delivery reports, on any headlines about force majeure or supply disruptions, because if backwardation is at 50 cents and widening, we're in the endgame. Let me also tell you what I'm not doing. I'm not panic selling. I'm not listening to the headlines that are going to call this a bubble bursting or a speculative mania unwinding. I've been through enough of these cycles to know when a pullback is real and when it's manufactured. And this one smells manufactured. The volume was wrong. The timing was wrong. The fundamentals don't support it. So I'm holding my physical, I'm watching my levels, and I'm waiting for the market to show its hand. Now, one more thing I want to address, because I know some of you are thinking it. If the banks are so desperate, if the shortage is so real, why don't they just let the price run? Why fight it? And the answer is because they're short. They're contractually obligated to deliver metal or cover their positions at a loss. If they let the price run to 100 to 120 to 150, the losses could be catastrophic. We're talking billions of dollars. So they fight. They use every tool they have. They dump contracts in illiquid hours. They spread rumors. They push the narrative that this is just a speculative frenzy that's going to collapse. They do whatever it takes to shake out the weak hands and buy themselves time. But time is running out. Because every day that the Shanghai Premium stays at $13, every day that backwardation persists, more physical metal flows east. The vaults get lighter. The squeeze gets tighter, and eventually there's no more metal to deliver. And when that day comes, the paper price becomes meaningless. The only price that matters is what someone is willing to pay for physical delivery. And that price is going to be a lot higher than $87. Now let me show you what this looks like from an institutional perspective, because I want you to understand the mechanics of the trap the shorts are in. Let's say you're a bullion bank. You sold a bunch of silver futures contracts at $90 because you thought the rally was overdone and you wanted to capture the premium. Your plan was to either let the contracts expire worthless if the price fell, or roll them forward if the price stayed elevated. But now you have a problem. The price didn't fall, it's still in the high 80s, and more importantly, the curve is in backwardation. So if you want to roll your short position forward to the next month, you have to buy back the near month contract at a higher price than the deferred month contract. You're paying to roll. That's bleeding you. And if you decide to just deliver the metal and close the position, you have to go into the physical market and buy at $100 in Shanghai or scramble to find inventory in the West, which may not even be available. Either way, you're taking a loss. So what do? You try to drive the price lower. You dump contracts during illiquid hours to create the illusion of a sell-off. You hope that triggers stop losses and scares retail buyers away. You hope that the price falls back to 85, to 83, to 80, so that your short positions go back into profit, or at least reduce your loss. But here's the problem. It's not working. The physical buyers don't care about the paper price. They're paying 100 in Shanghai. The backwardation isn't reversing, and every time you sell, every time you push the price lower on paper, you make it cheaper for the physical buyers to keep accumulating. You're feeding the squeeze. You're tightening the noose around your own neck. This is what I mean when I say the math doesn't add up for the banks. They're in a lose-lose scenario. If they let the price run, they lose on their short positions. If they suppress the price, they accelerate the physical drain and make the eventual squeeze even worse. The only way out is if demand collapses, if the physical buyers in the East suddenly stop paying $100 and accept the Western paper price. But that's not happening, and I don't think it's going to happen, because the Eastern buyers understand something that a lot of Western traders don't. This is not about price. This is about possession. This is about securing a hard asset before the system breaks down entirely. Let me give you one more data point that ties this all together. I was looking at inventory reports from the major ETFs and vaults earlier. The SLV ETF, which is the largest silver-backed ETF in the world, has seen outflows over the past few weeks. Not inflows, outflows. That means investors are pulling their shares and converting them into physical metal. They're taking delivery, and that's putting additional pressure on the vaults because every share that gets converted is an ounce of silver that has to leave the vault and go into private hands. Now, the ETF sponsors will tell you they have the metal. They'll publish their inventory reports and everything will look fine on paper. But if the metal is encumbered, if it's already been leased or hypothecated or promised to multiple parties, the actual available inventory could be a lot lower than the headline number suggests. And that's the scenario that keeps the shorts up at night. Because if enough investors demand physical delivery, if enough shares get converted, the vaults could run dry. And once the vaults are empty, the paper contracts become worthless. They're just IOUs backed by nothing. And this is why backwardation is such a critical signal. It's the market's way of saying, we don't trust the future delivery, we want the metal now. And the longer that signal persists, the more it confirms that the shortage is real. Let me recap where we are, because I know this has been a lot of information. Silver was smashed 5% last night, from over $90 down to $87.59. It happened during illiquid overnight hours on relatively low volume, which suggests this was not organic selling, but a coordinated effort to move the price. Meanwhile, physical silver in Shanghai is trading at over $100, a $13 premium over the Western paper price. The gap should be closing through arbitrage, but it's not, which tells us there's no available physical supply in the West. On top of that, the silver futures curve is in backwardation, with spot prices trading 30 cents higher than the March futures contract. That's a red flag that the market is desperate for immediate delivery and does not trust future deliveries. And finally, we have a major options expiration this Friday, with a lot of call options clustered around the $80 strike on SLV. If the price closes above 80, the gamma squeeze could be enormous. Those are the facts, the verified, measurable facts. Now let me tell you what I think is going on beneath the surface. I think the bullion banks are short silver.